Supply chain finance. Approach with caution. Supply chain finance offers short-term benefits to small businesses, but experts, who are calling for reform, say the potential risks far outweigh the benefits. Key takeaways from this audio article. Many small and medium-sized enterprises, SMEs, are struggling with cash flow management amid the slowdown in business activity. Payment agreements based on supply chain finance arrangements can be a good option to ensure early payment and improve certainty around payment times. However, these arrangements must be entered into with caution and an awareness of all the potential risks. In the world of small business, late payment terms and extended invoice settlement terms are more often the norm than the exception. Some would say they go with the territory of being in business. However, that is cold comfort to the millions of enterprises regularly struggling with cash flow issues as they wait on due payments to fulfill their own obligations. Prolonged payment delays can sometimes mean the difference between survival and default. This is why a growing number of Australian small businesses, which supply some of the very large companies in Australia, have been signing up to payment agreements backed by supply chain finance SCF arrangements to improve certainty around their invoice settlement times. SCF is a term that covers a range of different loan products provided by banks and niche financiers, predominantly to large corporations. They include reverse factoring products, whereby suppliers effectively sell their receivables to the finance provider in return for early payment. In doing so, they agree to take a discount on what they are owed. The company that was supplied the goods or services will then pay the full amount owed to the SCF provider at a later date, effectively improving its own cash flow in the process. When used to the benefit of both parties, SCF is a genuine choice for small business suppliers because it can be a cheaper option for early payment than other business finance products. Yet, a recent inquiry by the Office of the Small Business and Family Enterprise Ombudsman found that SCF products were being weaponized by larger companies to pressure their suppliers into signing agreements in return for being paid on time. According to Kate Carnell, the Ombudsman, the focus of the inquiry was to expose unethical commercial behaviours, bullying, and manipulation of suppliers, as well as lift the lid on subjugator tactics. She says, "One of the worst forms of supplier bullying is the example of an SME being told to deal with our SCF provider or wait for your funds. That is, being precluded from accessing their own debtor finance solution to gain payment earlier than agreed terms and potentially sustain a higher rate of discount." Carnell goes on to say, "I've been extremely disappointed to receive numerous reports of large businesses extending payment times or even suspending payments to small businesses in a time of significant pressure for the business community." End quote. Under the Business Council of Australia's Voluntary Supplier Code, all signatories must pay their small business suppliers on time and within 30 days of receiving their invoice. Following its inquiry, the Ombudsman is seeking the introduction of federal legislation to require all large businesses to pay their small business suppliers within 30 days from receipt of invoice. As part of that, it has called for a uniform definition of small business for the purpose of payment times and unfair contract terms, and for the federal government's payment times reporting framework to be promptly implemented and enforced. At present, the Senate is conducting a review of Payment Times Reporting Bill that establishes new reporting obligations on the payment practices of large businesses in relation to their small business suppliers. Several countries in the European Union have already mandated payment terms, some across the economy and some between large and small businesses. New Zealand is considering legislating a maximum payment term of 20 days. The UK recently introduced a voluntary prompt payment code based around a 30-day invoice settlement time. However, formal legislation is yet to be passed, and like Australia, problems still remain. Carnell says she's particularly heartened by a major global SCF provider, Greensill Capital, recently stating it will not service companies that blow out their payments to small businesses and by a number of large companies announcing they will move to shorter payment timeframes to suppliers. The founder of UK-based Greensill, Lex Greensill, has gone on record to say, "We will not support big companies bullying their small and medium-sized business suppliers, and if they do, we will terminate those contracts." Since the beginning of this year, construction giant CIMIC Group announced it was reviewing its SCF arrangements. Meanwhile, iron ore miner Rio Tinto brought forward payment terms for most of its 10,000 Australian suppliers to 20 days, dumping its practice of applying payment discounts to suppliers wanting to be paid in fewer than 30 days. Telstra also cut its payments terms from 62 days, introducing new terms to pay suppliers with annual invoices of up to $2 million within 20 days. In addition to scrutinising large companies that have been serial offenders in dragging out their supplier payments to beyond 30 days, the Ombudsman has focused on the use of artificial intelligence, AI software, by some financiers to identify suppliers in financial stress that are more likely to accept discounts. The Ombudsman has also called on the Australian Competition and Consumer Commission to look into the use of data and AI software on SCF platforms. According to Rob Nichols, Associate Professor of Business Law at the University of New South Wales Business School and the Director of the Business School's Cybersecurity and Data Governance Research Network, SCF providers are using machine learning software to evaluate the highest returns for the lowest risk. He says, "In the case of SCF, the return represents the discount that the supplier is willing to take in order to be paid in a timely fashion. One of the outcomes of the application of all three forms of machine learning is the ability to target groups or classes of business that are more tolerant to higher margins." Carnell says that being able to identify businesses under stress and then to use that information to coerce businesses into accepting a discount is not okay, and it's not ethical. The Ombudsman has also examined how current accounting standards enable larger companies to move SCF liabilities off their balance sheets and effectively inflate their reported cash flow position, which can mask financial problems that are not disclosed to their shareholders. A joint submission to the inquiry by CPA Australia and Chartered Accountants Australia and New Zealand highlighted that insufficient, inaccurate, and poor disclosure on SCF arrangements, including reverse factoring, could potentially contribute to a lack of understanding of corporate performance in this area. The submission noted, "Although there are a number of accounting standards within the Australian Accounting Standards Framework that are relevant to the disclosure of SCF arrangements, we believe there is scope for the development of guidance regarding financial statement disclosures by businesses that have entered into SCF arrangements." CPA Australia says guidance taking into consideration relevant accounting standards will potentially be helpful to financial statement preparers in applying professional judgment in presenting accounting treatment of SCF arrangements. It said, "Further such guidance should enable users of financial statements to form a more informed view on the impact of SCF arrangements on the financial position, performance, and cash flows of the business." Carnell says the use of SCF can disrupt the established financial reporting practices by blurring the line between trade payables, trade creditors, and debt. She says, "The wide range of variations in SCF programs available further complicates the accounting and reporting of SCF transactions, meaning there cannot be a one-size-fits-all reporting guidance, solution, or standard," she adds. She then goes on to say, "Perhaps more important is the potential impact of SCF transactions and their accounting treatment on the cash flow statements of the reporting company. The decision as to whether SCF is reported as trade payables or debt is critical in determining whether SCF impacts a company's operating or financing cash flows." International credit agencies Moody's has said, "Companies using reverse factoring should disclose it as a liquidity risk due to the artificial boost it can provide to working capital metrics. This liquidity risk manifests when, given the potential size of some SCF programs, the cancellation of the programs can lead to a sudden outflow of working capital across a short payment of time, creating liquidity pressure. The US Securities and Exchange Commission is advocating for new rules governing how companies should disclose SCF schemes, claiming their rising popularity has masked hidden risks. Carnell says there's further work to be done by the Australian Accounting Standards Board and regulators, including the Australian Securities Exchange and the Australian Securities and Investment Commission, on the disclosure by large businesses of their use and impact of SCF programs. The Accounting Standards Board has written to the International Accounting Standards Board to seek the development of further guidance around the disclosure of SCF liabilities in financial statements. Carnell says, accounting standards aren't simple things to move, and particularly with international standards being the basis of where we're all trying to head in this space. So these sorts of processes are long. There needs to be better education on guidance notes, including companies being required to address supply chain financing in financial reporting. It isn't a big ask. It's not like companies don't know.